Good day, fellow investors. As we do a lot of analysis, we discuss things, we try to be smart about things. The main question is, can we trade the market? If you just take a look at the market, you see here, okay, exuberance, 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 just sell a little bit here into that exuberance, and then as the market reverts logically because of bubble and everything, here you buy more. And if you do that over time, exuberance, panic, buy more here, you can make really good money, right? And I get a lot of comments there. Sven, if we dollar cost average to buy index funds but stop in times of exuberance and add more than normal during times of uncertainty, won't that trend average higher, effectively beating the market? So very simple, possible, sounds really smart, sounds easy. And then also James discussing also on those ETFs. If we apply value principles to ETF investing, and when what allocations to increase, well, not to increase, to hold during 50% declines and so on, then everything should be much, much easier, even if we use ETFs. So allocations, this or that. I might not really agree on that because there are three things that I really want to discuss when it comes to such ideas about the market. The time range of your assumption of panic versus exuberance. How far will it go or not? Relativity to comparing something that is again relative, not the real fundamentals that we'll discuss at the end of this video, and how to focus on fundamentals, not at market timing. And then there are always things that you haven't yet experienced, or you have but you haven't noticed it, which is, for example, a melt up. So let's start with the time range of your assumptions. So you look at this, okay, this was pure exuberance, we should have sold here, Sven, a recession is imminent, it's easy to sell, 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 and then you buy back when things are lower. Very easy to look now back and say it was expected. The Fed was saying it will increase interest rates. The time was to sell. Let me just show you something else. With that attitude, yes, now it looks very easily, but you would have sold here in 2017, you would have sold here in 2015, and most importantly, you would have sold in 2011 and not bought back here in 2012 because there was a recession tragedy in Europe, everything was bad, and you would have simply missed out on this, which is just 227%. So you're thinking, okay, I can be smart about the market, I can do this, but the time range of your expectation makes it impossible. If you look at short term, yes, it looks okay, exuberance here, really a boom here, we should have sold here and bought here. But the question is, are you buying now here or not? Will it go up or down? And that's the trick here that makes it impossible to predict. Plus, we have relativity versus fundamentals. If you focus on expensive, cheap, then you always compare with something that was in the past or something else, which might be again the wrong confusion, because if you compared, okay, in 1987 this is expensive, then you see that you miss a lot. If you compare to not real fundamentals but relative fundamentals. Yes, in 2000s the market were expensive, especially the dot-com bubbles related things, but again, those who missed out or sold, they were feeling smart for 12 years, but afterwards not that much. So there is always relative thinking versus real fundamental, comparing relative fundamentals versus real fundamentals. And then there are things that you have experienced, but you are not thinking about it. This 40-year 40x in the S&P 500 is something that nobody thinks about. Sven, stocks is normal that always go just up, up, and that's it. Stocks will go up and we do what we can. We buy more here, we sell here, and we make a lot of money in the process. You have experienced the biggest bull market in history of mankind. That's what you are still living it. So maybe you are not noticing it, but this is the biggest bull market ever. So that's why you have to think your assumption of just trading the market, and you say, okay, now I have sold, but I think there is a distinct possibility that we see the S&P 500 at 8,000 points 5 years down the road. 10,000 points in 2030 is something that can be. And if you sell now on the Fed increasing interest rates, this and that, then you might miss out of that. I don't know what will happen. There is a possibility. And also keep in mind that over the last 40 years, you have been living in a period of constantly decreasing interest rates that benefit the market. We are still at negative inflation 9%, effective federal funds rate 1.21%. We are still at -8 real rates. That's extremely stimulative for everything. So if we revert to positive real rates, the market can go to 2000, even lower. So over the next 10 years, this can be 8,000, 10,000, or 1,500. I wish I knew, but that's the message. I cannot know. And therefore, these questions look smart, everything you feel there might be something, but there actually isn't. And if you want to focus on fundamentals, you have to start thinking, okay, how does this 5% dividend fit me? How does Starbucks, the growth and the dividend fit me? How does the brand fit my portfolio? How does ADM, the business, the food value fit me? How does HP that Buffett bought, he is happy with 3% dividend buybacks and also the long-term trend there in growth? How does maybe a gold company fit me with the dividend and the effect on my portfolio that we discussed last week? So that's something you have to think about. And when you start thinking about that, you start focusing on better and better fundamentals, no matter what happens with the market, with recessions and everything. And for me, in my personal opinion of 20 years of investing, that's the only thing that works. If you want to think in that way, subscribe to the channel, smash that like button, check what I do. We have also the YouTube portfolio that we follow, and I'll see you in the next video.